If you love trading flag patterns, well, lucky for you, because in today's video, we're going to explore a unique TradingView indicator that can be used to automatically identify and plot the flag patterns. That indicator is called the Flag Finder. We're going to explore what this indicator is, and we'll also combine it with other technical indicators to try and see how this indicator can be used in a simple strategy. If you end up finding this video helpful, remember to leave a like. Let's get into it. Now, what exactly is a bullish flag and a bearish flag? Well, let me show you an example. Let's start with a bullish flag on a naked chart. The formation of a bullish flag usually starts with a strong aggressive upward move representing the pole of the flag. Ideally, this move is usually between 1 to 2% of the asset's value, indicating a strong buying momentum. After the bullish move, the price starts moving sideways, creating a rectangular shape or a slight downward sloping channel. This is the flag part of the pattern. The top and bottom of this consolidation should be well defined. This sideways movement should last between 3 to 5 candles. If it's too short, it may not be a reliable flag. If it's too long, then the initial momentum might be lost. This bullish confirmation comes when the price breaks above the top of the flag, ideally on a higher than average volume. This breakout signifies a continuation of the initial bullish trend and provides a potential buy entry point for traders. Conversely, the bearish flag starts with a rapid and aggressive downward movement, which should be around 1 to 2% of the asset's value. This strong sell-off forms the pole of the flag. Following the bearish move, the price then starts moving sideways or even forms a slight upward channel, creating the flag. Again, this consolidation should be visible for about 3 to 5 candles to be considered a valid flag pattern. The bearish signal is confirmed when the price drops below the bottom of the flag on strong volume, suggesting that the bearish trend is set to continue. This provides traders with a potential sell or short entry point. Now, to add the Flag Finder indicator to our chart, we're going to open the indicator search tab and type in Flag Finder and select this one by this guy. Now, after adding this indicator, you might notice that there isn't anything visible on the chart. So where did the indicator go? Well, in order for this indicator to function, we need to change some settings. Let's click on this gear icon to access the settings panel. Then here, we'll modify the indicator settings and explore what each of these options mean. Firstly, there is the maximum flag depth, which indicates the maximum pullback from the flag's high to the flag's low. We don't want to have a super wide flag, so let's reduce this to 0.5%. Yes, this value is in percentages. Next, we have the maximum flag length. This parameter defines the number of bars that the flag can span, and we'll leave it at the default value of 10 bars. Then there is the minimum flag length. This denotes the least number of bars for a pattern to be recognized as a flag. We're gonna set this to 5 bars. Then we have the prior uptrend minimum. This determines the minimum percentage gain before a flag can form. For this strategy, we're gonna set it to 1%. After that, we have the maximum flagpole length. This specifies the longest span of bars that the flagpole can cover. We don't want to increase this because the flagpole will span over dozens of candles, so we're gonna stick with the default value. The minimum pole length will be set to 5 bars. These settings are for the bullish flag patterns and will apply similar ones for the bearish flags. The maximum flag rally is the same as the flag depth, so we're gonna set it at 0.5%. The flag length remains at 10. Minimum flag length increased to 5. The prior downtrend minimum, we're gonna again keep it at 1% to have it be the same as the bullish flags. This is gonna be left at 15. And we're gonna increase the minimum pole length to 5 to have it be the same as the bullish flags. After all those settings, click OK. Now, as we can see, this is the indicator. It's composed of bullish and bearish flags. This is a bullish flag identified by the indicator. This is the pole of the flag, and this is the flag itself. Conversely, this is a bearish flag. As you can see, this is the pole and this is the flag. Next, we're going to explore how we can use this indicator to trade. But before that, let's talk about hankotrade. Now, you may be thinking,
and what exactly is hankotrade?
hankotrade is one of the most reliable Forex brokers out there. And for that reason, I use them every single day. As you can see here, this is my trading history. I mainly trade gold. And up here you can see that this is actually a live account. The reason why I love hankotrade so much is because of their extremely low commissions and spreads. On Forex, for example, the spreads can go as low as 0.0 pips, which is actually the lowest they can go. For those of you who love high leverage, hankotrade offers a maximum leverage of 1 to 500. If all of that isn't enough, they're also going to give you a 100% bonus for all your deposits up to $25,000. So if you deposit, say, $500, they're going to give you a bonus of $500. So now you'll have a total of $1,000 to trade with. To access the bonus, as well as all the other perks, sign up to hankotrade using the link in the video description. Now, back to the video. Now, to use this indicator to trade is really simple. It's one of the most simplistic indicators to use on the planet. Whenever a bullish flag pattern is identified and the price breaks and closes above the flag, we enter a long trade. Stop loss just below the low of the flag, and for the take profit, we could set it at 1.5 times the risk. For a short trade, we need a bearish flag pattern to be established. Once the price breaks and closes below the flag, we enter a short trade. Stop loss just above the high of the flag, and for the take profit, we could set it at 1.5 times the risk. Now, in order to craft our strategy around this indicator, let's add a trend filter indicator and a volume indicator to minimize some of the false signals that might be produced. On the indicator search tab, type in market bias. Select this one by Professor X. Next, type in volume and choose this one by TradingView that's under the Technicals tab. Double-click on the market bias indicator to access the settings panel. On the Inputs tab, change the period to 150 and the smoothing to 30. Head over to the Style tab and uncheck the Heikin-Ashi Smoothed option and then click OK. Next, for the volume indicator, go to the Style tab and change the volume MA color to white and then click OK. Now that we've added a trend filter indicator and a volume indicator, let's go over the conditions for entering trades with all the three indicators combined. Now, to take a long trade, these are the conditions. First, the trend ribbon of the market bias should be colored green and the price should be trading above it. This indicates that the market is in a bullish trend. Second, we want a bullish flag to be printed by the flag finder within this bullish trend. To confirm that, we're just going to wait for the market to play out. And this is our bullish flag pattern. After we have the flag, we want the market to break and close above the high of the flag without breaking and closing below the low of the flag. As you can see here, the market broke and closed above the high of the flag and it never closed below the low of the flag. If it were to close below the low of the flag, we wouldn't take that trade. Another important thing is that we want this breakout to come within 15 candles after the establishment of the flag. Now, to confirm that, we're just going to take this measure tool and we're going to place it on the first candle after the establishment of the flag. And then we're going to drag it forward until it says 15 bars right here. So this is going to be our window for the breakout to occur. If the breakout doesn't happen within this window, that setup becomes invalid because the momentum of the flag may have diminished. For this particular trade, we can see that the breakout happened soon enough. Last but not least, we're going to pay attention to the volume indicator. We want the volume bar of the breakout candle to be colored green, and it should also be above this white moving average. This indicates the presence of enough bullish volume in the market to push the price all the way to take profit. All our entry conditions are met on this candle, so we're gonna enter a long trade here. The stop loss is gonna be set below the most recent swing low. For the take profit, we're gonna set it at 1.5 times the risk. We let this trade run and take profit. Now, to take a short trade, these are the conditions. First, the trend ribbon of the market bias should be colored red and the price should be trading below it. This indicates that the market is in a bearish trend. Second, we want a bearish flag to be printed by the flag finder within this bearish trend. To confirm that, we're just gonna wait for the market to play out. And this is our bearish flag pattern. After we have the flag, we want the market to break and close below the low of the flag without breaking and closing above the high of the flag. As you can see here, the market broke and closed below the low of the flag and it never closed above the high of the flag. Another important thing is that we want this breakout to come within 15 candles after the establishment of the flag. Now, to confirm that, we're just gonna take this measure tool and we're gonna place it on the very first candle after the establishment of the flag. And then we're gonna drag it forward until it says 15 bars right here. So this is gonna be our window for the breakout to occur. If the breakout doesn't happen within this window, that setup becomes invalid because the momentum of the flag may have diminished. For this particular trade, we can see that the breakout happened soon enough. Last but not least, we're gonna pay attention to the volume indicator. We want the volume bar of the breakout candle to be colored red and it should also be above this white moving average. This indicates the presence of enough bearish volume to push the price in the direction of our trade. All our entry conditions are met on this candle, so we're gonna enter a short trade right here. The stop loss is gonna be set above the most recent swing high, and for the take profit, we're gonna set it at 1.5 times the risk. We let this trade run and take profit. Now remember, the strategy showcased in this video isn't foolproof and should be taken with a grain of salt. You shouldn't backtest this strategy with the aim of trading it blindly because it lacks price action. Price action is crucial in any trading strategy and is super subjective. It should be learned on your own. And then once you know price action, you can use it on top of any technical or indicator-based strategy like this one. I just think it's essential to mention that because I see many of you in the comment section wondering why we don't backtest these strategies or saying things like you've backtested one of our indicator-based strategies and it didn't work. The truth is, no indicator-based strategy will consistently work on its own. Indicators are just complementary tools meant to assist your primary strategy, which should be rooted in price action and may include things like fundamental analysis and sentimental analysis. That's been it for this video. I hope you found some value. If you did, hit the like button below and consider subscribing to stay tuned. Thanks for watching. See you next time.